I, of course, do like to start off the show with a summary of kind of what I saw happening in the market this week. This, of course, is the year-to-date chart that we always look at here for the S&P 500. You can see kind of the ups and downs that have happened. That blue line is the 200-day moving average, and I've drawn a red line across a couple of the high points for the year. We can see that that's down, obviously, as far as this goes. So some very significant things have happened this week, just in the sense that we've been retesting these low points, and we got all the way down, to the 50% retracement level. So if you go to the bottom of 2020 to the top, which is this year, and then look at how far down it's come, it's retraced about half of that gain, and there was a lot of buying that came in right at that point. So we've been holding up pretty well. There's a couple of things that are really driving the market upward right now. Number one, this is what they call earnings season. So we got all these companies reporting earnings. We've had 101 companies of the S&P 500 report so far, for example. And according to Bloomberg, since 2013, the S&P 500 goes up 76% of the time during earnings season. So really important category as a whole. Next week is the big week. That's when we get the Apples and the Googles, Microsofts, and et cetera. So it's the big tech week. And oftentimes that's actually been a pretty good week for the market. These are great companies, and we'll see what happens. What we have seen so far in terms of earnings is that 73% of the companies have beat their expectations, which is actually pretty good. The average is 77%, so kind of in that same neighborhood. And the one big difference is that they haven't beat it by very much. So on average, the companies beat their expectations by 8.7% on their earnings growth. This quarter, it's been 0.1%. And these, of course, expectations have been lowered some, and we'll have to see how that plays out. But so altogether, we're seeing some good things happen. We have one other kind of seasonal piece that usually pushes the market up, and that is midterm election year. And so if you look back over the last 70 years at all the midterm elections, and you look at the pattern, it generally bottoms out around the middle of October. And lo and behold, so far this year, we're kind of bottoming out on October 12th, so pretty close. And then we have a rally that comes through the end of the year, right, and kind of pushes things up. Got earnings season plus that seasonality of the midterm election are kind of the parts that might move it forward. I guess the biggest difference to me, though, is that if you look back at that 70-year history of midterm elections and look at that pattern, how is it going to react in a situation where you have a pandemic that's affecting China, a war in Ukraine, and a high inflation rate, really around the world? That hasn't been there in that 7-year data, set. So we'll see how that plays out and what has you. But we saw a pretty good run up today. We have the Federal Reserve interview with the Wall Street Journal, and a couple sources are saying that basically they maybe would do less rate increases in December, and that's a big deal right now because it's already kind of a foregone conclusion as far as the market's concerned that November 2nd, we're going to have this 3/4 point increase. Well, 75% chance that we're going to have a 3/4 increase in December as well. But after that article in today's Wall Street Journal, that dropped down to a 58% chance. So still a majority chance on a betting basis that we're going to have 3/4, but it's backing off a little and the market's coming up from that, right? So, we're seeing some good things and maybe we'll see some movement upwards. The problem is if you look closely at this chart, we've had so many strong movement upward. I just saw a little table today that showed, between 5 and 10% positive moves up. There's been 10 of them so far this year. Even though the market fell 25% in total, we still had 10 situations where the market was up kind of in that 5, 10+% range. You can see some of the big ones here, but there's lots of small ones. And so that's the problem. You can get a decent week like this week looks like it's going to be. You can have some good runs, but is it real? Does it really break out? Do we change the primary trend from down to up? And really, I think there has to be some other things in place before that happens. I think we can have a decent run right here, maybe even through the end of the year. But is it enough to draw us back into, a primary trend on the up? I think we need to see some other things. And a couple of things that I think are kind of weighing on the market is, first of all, this is the leading economic indicator put out by the Conference Board. The blue line there is the leading indicator. The gray line that's kind of underneath it is what they call the concurrent indicator, which just means that it's essentially the existing economy. And so those gray bars there are the big recessions. And so the first one over there is 2000, and that obviously was a big downturn, over 45%. And then the second one, of course, was 2008. Stock market dropped 57% there. And if you look, just got reported on Thursday, September was down again. Very definitive top. I mean, look at that, actually. It's better. It's a stronger top than what we saw in 2000 or 2008. And so that tends to lead these big economic downturns, which tends to lead these big downturns in the stock market. And so if you go back to 1960 when this started, it's got a pretty phenomenal track record of kind of leading these big economic downturns, which usually lead to big stock market downturns. So, but it can be early. Like if you look back to 2008 when it peaked there, it peaked about 12 months before the market started to really fall apart. So it can take a while for that to translate. But there's, to me, we have these headwinds that are pushing things forward, like the seasonality of the midterms and the earnings season and all that type of stuff. But we also have some really, things that are kind of pulling us backwards too. And this would be one of the things. And this is reported once a month. It was just reported last week. So I consider this one of the key components to watch. It's one of the most important things as far as I'm concerned, just because it has such a good track record. But one thing that I've been doing the daily updates all week. I've been talking about the 2-year and the 10-year Treasury yield. So this is the 2-year Treasury yield, right? So this thing went from about 0.2% to now about 4.5%, really, in a 1-year period. And you can see how strong it is moving upward. This 2-year Treasury yield is very sensitive to the Federal Reserve. And so as you see this thing moving upward, it is projecting what the Federal Reserve might be doing. And so historically, when you go back to these higher inflationary periods, this will peak out at around the same time the stock market bottoms out, right? And so, but we need to see a peak out, right? I mean, there's nothing on here. The 200-day moving average is going straight up. It's that blue line. The yield is kind of got a few little peaks here and there, but pretty strongly up and not falling really at all. Falling a little bit today based on the Wall Street Journal article, rightfully so, just kind of readjusting in case there is less increase in rates than people thought. But the bond market is really good at kind of figuring out what's going on with the economy, and it's one of the reasons why they talk about the inverted yield curve. And that's probably the number one predictor of economic, recessions that might be coming. And that's because the bond market's quite good at looking at what might happen to the economy in the future. So if we see this 2-year Treasury peaking out and starting to come down, that might be a point in time where we really start to believe a lot more in the run-up that might be happening at that point in time as a potential change into a primary trend up instead of primary trend down with just another fake move, right? So today we're up. This week we're up. Well, so is the 2-year Treasury. To me, that means it's a false move. If you look at this, we had that massive run up in the summer. We don't see a big breakdown here in the 2-year. So the 2-year was telling us that the summer rally was a fake move, right? And rightfully so, it was. So the 10-year Treasury is also worth watching. Although if you look closely at that big dip here, just kind of right over my head, that was the summer. So it did break down. And it signaled that maybe things would be doing better. But the 10-year is not as good at predicting what's happening, at least in this particular time period, because it seems like the 2-year is much more locked in on what's happening with the Fed. But these are two pieces that we'll be watching really closely, along with that leading economic indicator, to try to tell when we might see some type of a scenario where we have a peaking of the interest rates, signaling a potential drop in the Federal Reserve's, rhetoric, maybe finally signaling a drop in 3/4 point increases, finally getting down to go in the opposite direction at some point in time. And all of this is kind of predicated on what's kind of normal and what have you. The one thing that could change everything we're talking about here quite quickly is something breaking, right? And that is a much higher probability here. Usually the things that break that we're not talking about are the ones that are the most damaging. And, there's lots of things we can talk about with Russia, Ukraine, Europe itself, emerging markets that are struggling, China, that's having problems, the dollar, which is driving up and up and up, causes potentially something to break, But I'll give you an example. I mean, one of the things that kind of really scared the market a few weeks ago was the fact that the UK came in with a new prime minister, going to cut taxes, going to increase debt. Of course, increasing debt right now is a trouble because it's really expensive. The rates have gone up tremendously. And that bond market started to kind of implode. And what we found out was that the UK pensions had a lot of leverage. That was a surprise, right? That's what I'm talking about. It's those things, again, that old saying that Greenspan had, who was a former Federal Reserve governor, when the tide goes out, you can see who's swimming naked, right? And it's exactly that. So when you put pressure on the whole system globally, we'll start to find out, wow, the UK's pension system is highly leveraged. It's like, that doesn't, wasn't something that we knew about. When Lehman failed, what we found out was that there was an awful lot of credit default swaps that were out there, more than was expected, and then those ended up having to be paid off, and everybody had to sell all their stocks to pay those off. But that wasn't what was expected at the time when they let Lehman go. Otherwise, the Treasury and the Federal Reserve might have bailed them out, like they did Bear Stearns just before that. So these are the things that that are out there right now. I'm hoping that we're already hitting a bottom. We're building this little base in the market, and we're going to kind of come up. But we really need to see some confirmation. Can't have the leading indicators going down every single month. Can't have the 10 and 2-year treasuries going up substantially and expect that this particular run-up's going to be the end, right? We need to see some of those other things peel off and keel over before we can probably see a sustained run that will change this primary trend from down to up. So anyway, that's our outlook right now. Very interesting time frame as usual. Look forward to being able to cover this in a couple of weeks. I'll give you my summary.